Long-term bond yields are hitting 7-month lows. Let's discuss with the Trading Nation team. Gina Sanchez, Chantico Global, Matt Maley with Miller Tabak. Gina, stock market is up. The economy is up. I don't understand why bond yields are down. Please help us explain.
Well, the yield curve has been doing something called bear flattening. That means that the short end has been coming up, anticipating Fed interest rate hikes, which have happened, but the long end has been falling. And that's basically the long end of the bond market saying, we don't believe in reflation. We don't believe that the economy is going to be as strong as you think it's going to be. And that's why it's called a bear flattener.
What's a bear flattener, Gina? Explain that in layman's terms, please. It could be a steamroller, I guess, or a big truck, but I assume that's not what you mean.
No, that's not what I mean. Generally speaking, when you expect interest rate hikes, the short end of the curve will come up to anticipate those interest rate hikes. However, if the long end of the curve doesn't believe there's enough inflation or doesn't believe there's enough growth, economic growth to support those interest rate hikes, they will fall. And so basically, as the short end is coming up, the long end is falling. That's basically flattening the curve in a way that suggests that we have a bearish outlook.
Okay, Matt, you've talked about bullish surveys and investor sentiment on some of the shorter end T-bills, et cetera. How do you explain the bond market and the stock market as well?
Well, I mean, as Gina says, there's plenty of reasons for the stock to look for yields to go lower here. We saw with the durable goods numbers this morning, it's just one in a long line of numbers that have been weaker than expected, and we see that with the City Economic Surprise Index. We also have the Atlanta Fed and the New York Fed both lowering their estimates for GDP growth in the second quarter. In fact, New York is below 2% now. And we also have commodities. I mean, oil's not the only commodity that's coming down. You see the industrial commodities, actually, their decline has accelerated over the last couple of weeks. So there's a lot of reasons that Gina points out to think that the long-term yields will continue to go lower. However, we have to be careful a little bit here because the positioning in the 10-year note is getting very, very crowded. Everybody is long. In other words, they expect the price to go up and yields to go down. You look at the COT data, commitment to traders data, shows the speculators, who are usually wrong, are getting loaded to the gills in these things. Sentiment is also starting to get a little extreme. The futures traders are 78% of them are bullish. Yeah. That's not to the same extreme. That has to get to like 90% to really get there. But if it gets to that level, we'll have the same extremes to that side as we had on the other side in December, just before the market turned. So I do agree that long-term rates should head a little bit lower here, but you got to be a little careful as we move through the summer. If everybody moves to one side of the boat, we could have a little bit of a reversal. Well, if they get to 90%, let us know. But you just gave good news for home buyers, probably because mortgage rates may move down as well. Matt and Gina, thank you both very much. We'll see you online because we do 2 more segments every day at tradingnation.cnbc.com.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.